So hi, Urs. We're diving right back into the numbers today. We are on Zoom while I'm in the States, and you're back in Switzerland. So today we're going to be covering the German economic sentiment as well as the US economic consensus and the Great Britain interest rate decision that took place. And then we will get into Switzerland and the developments at the Swiss National Bank that decision was made. So we will get into that a little bit later. So in Germany, we see an interesting move in the economic sentiment in terms of its coming up. It's actually the highest it's been since February 2022. Still quite low actually, and didn't necessarily hit expectations of where they wanted it. But at the same time, it's moving in that upward trend. Maybe, Urs, you can shed some light into the situation and what you're really looking at there in the German population.
Yeah, I mean, the German population or the German economy is the biggest within the European Union. And so it has quite some weight. But as we have discussed in the past already, Germany has been in a recession and it's coming out of it, but still isn't out yet. And so it's really like the sentiment is important to see that it goes into the right direction. And
That's
so
right.
it's going up, but it's still not where it has been. And it also shows a little bit of like the mentality of the German people in general, because German people like of how they are, how they function, it that they're trying more to be conservative, even so if things start to look better, so they are not that sure again. So it makes sense that the sentiment is still not where it has been, and also with all the like global movements that are going on, and like the most recent elections going on in the EU. I mean, that hasn't been counted into this data already, but the expectations were already quite insecure or unsure where it is going, where the European Union is heading, and so we will see how this has an impact on the further development of Germany.
Yeah, it'll be fascinating to see. I mean, they've really come out of a hard economic time, so maybe that's part of the reason that we see where it didn't quite hit where it they were hoping it would hit in terms of the economic sentiment, because people are a little bit more concerned about, okay, are we really coming out of this? But yeah, it'll be fascinating to look at. So moving on to the University of Michigan consumer sentiment, it's now fallen for the third straight month. It missed the forecasts by almost 6.5 points. So there we kind of see this drop. Mainly the pessimism seems to be coming from inflation being a major issue and how that's affecting the income of the population. What's interesting here is their year ahead inflation expectations haven't changed. They think inflation will be around 3.3%. And for their 5 year, it actually went up by a 10 basis points to 3.1%. So the expectation is that inflation is going to stick around for quite some time in the US. And that's kind of, I guess for me, when I look at that, that's a little bit concerning to think this is how the population feels, and they're not necessarily positive on the forward looking economic environment for the US.
Yeah, I mean, the inflation sentiment or the inflation forecast is way above what the target level is. And so, I mean, last week I was in California, in San Diego as well, or it was even this week. And I spoke to people and they were really like concerned about prices. Also, input prices are going up. They said, I spoke to a business owner and he said he's selling his services to his clients, and his were going up within the last year by 30%, but his input prices went also up by 30%. So it really is a concerning development in the US, and it does make sense that the consumer sentiment is coming down again, because people really start to feel what it means to run out of savings, for example, and to be confronted with new costs over and over again, while at the same time the salaries are not going up that much anymore.
Yeah, absolutely. And this is, I think, something where, people kind of, we can get lost in the short term to a certain extent that inflation is, well, it's only 3%. So it's just a little bit higher, but that's that 3% higher than where it was last year. And so that basis effect that we talk about so often, it's just really starting to pile up and really, I think, hit the American consumer really, really heavy. And so
And
it's that story that you shared is really, I think it's indicative of a lot of what's going on in the US. So let's
Also within maybe within the last couple of years, the inflation, like the accumulated inflation, has been more than 20%. So
Yeah,
it's not really like just the 3%, but
correct.
prices were increasing over and over again. And I read an article the other day that the salaries, they were also up, but they were not up as much as the inflation, as I was just stating.
Yeah, exactly. I think that's always the that's always the risk in things that you run into when inflation hits, and why people don't like inflation. I mean, this is why economists talk about you really can't let inflation get out of control. And on that note, it's interesting. Let's move on to the Bank of England had an interest rate decision. They kept it as normal, which was interesting to see that two of their members advocated for a decrease by 25 basis points to 5%. But they still really thought, hey, we need to hold this, even though inflation is at that 2% mark for us in the UK. Um, I think this was quite an interesting move from the Bank of England to say, okay, like things are starting to look decently okay in terms of our inflation, but we're going to leave it high because, we want to actually make sure that this becomes the status quo and we don't lose control of all the work that we've done to get to this point.
Yeah, I mean, I totally agree with you. I think it was quite a kind of a bold move to stay at 5.25% because for England, they are also in a tough economic
Yeah.
position right now. So higher interest rates also mean higher financing costs, which could lead to harm to the economy and also to the people who have mortgage rates they have to renew. But I think it is important to stay at this rate for a little bit longer as they did to really reinsure that the inflation is not picking up again, as we have seen in the past. I mean, in the 80s, there was like a second wave. And so that is really the main concern of the central banks right now. So to make sure that they really have it under control and not having to deal with another uptick in inflation, which might be even worse than what they experienced in the first round of inflation.
Yeah, no, I totally agree with that. And so I think with that, we see this surprise move to not lower interest rates. On the other side, Switzerland just lowered their interest rates by 25 basis points from 1.5% to 1.25%. Quite interesting to see inflation kind of dropped in Switzerland. And this was kind of, the mandate of the SNB being price stability. They thought it was time to adjust and make sure that the interest rate went down. What was kind of your kind of look at this movement, especially with a lot of other countries just holding or slightly dropping, or even the juxtaposition of what Switzerland looks like compared to the other financial jurisdictions and economies?
Yeah, I think it's interesting to see from the Swiss perspective. For me, it was a little bit unexpected. I thought they would wait another interest rate decision. I thought there will be another drop later in the year. So to have two decreases just in a row, that's not very typical, I would say, for Switzerland.
Hmm.
But I think it makes a clear statement where they are and what their expectations is. And what you have to see from a Swiss perspective is Switzerland is a rather small economy, so we have a lot of trading with foreign countries, and so a lot of inflation is dependent on what are like the prices from the products we import,
Mhm.
and so the statement from the Swiss National Bank was they try to release pressure from within the economy rather than having it further decreasing from abroad. And so with lowering interest rate, that means a weaker Swiss franc. And I think that is important also for the economy to further like having some counter movement going on to the prices, to the input prices. Because if you increase your salaries, but at the same time can decrease or calculate with lower prices from products you import, then you can level this out again. And so I think it is an interesting move from the Swiss National Bank, and at the current point or where we stand at the moment, there is not too much of a risk that inflation will get out of hand.
Yeah, I think that's a good assessment of the situation. So, Urs, that's us for this week. Actually, we're gonna take a 2 week break now, get some time off to focus on some
Right.
things else, and we'll be back. Looking forward to bringing this to everyone again.